Welcome to the Pirls Stock Market Commentary video, your weekly window on stock market technical conditions, featuring the proprietary bull-bear point and figure market breadth summary chart for August 5th, 2018. Market breadth. With this past week's market decline, our bull-bear point and figure ratio at 1.04 fell slightly from 1.07 last week. The total count of securities in bullish or bearish patterns decreased 1% to 2,862. The count of bearish stocks decreased fractionally, while the count of stocks in bullish patterns decreased 3%. The Pirls P&F market breadth summary chart shows us a market now 4 weeks in bullish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the weekly Pirls Stock Market Commentary via email, free of charge, simply enter your name and your email address in the spaces provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 175 points for the sixth decline in 8 weeks. At a positive 30.97 points, it continues below all 8 tops above plus 100 in the last 30 months, and it continues above all 4 bottoms below minus 100 in the last 30 months. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither accumulation nor distribution mode, with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 2 accumulation days and 2 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in neither accumulation nor distribution mode, on higher average daily volume. Momentum. The CCI 20 daily at a positive 21 is above positive 16.99 last week, falling below minus 50 before heading back up and continuing in a Woody's uptrend. The CCI 20 daily is now within the plus or minus 50 range for a zero-line reject long entry signal if the CCI 20 daily drops, then rises early next week. In Woody's CCI trading system, 6 consecutive bars above or below 0 are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 118 weeks ago, while the daily CCI 20 began a Woody's uptrend 3 weeks ago. The CCI 20 weekly fell to a negative 83.68 from a positive 102.45 last week, continuing outside the plus or minus 50 range required for a valid zero-line reject long entry signal. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: REITs on top, gold and silver, brokers, and some tech on the bottom. Bullish, gold and silver continues in the bottom 5. REITs has entered the top 5. Bearish, computer hardware and disk drives continue in the bottom 5. Brokers and networkers have entered the bottom 5. KBW Bank has left the top 5. Focus this week from www.theautomaticearth.com. Gold, yuan, crypto. We recommend reading the entire article, which is an excellent overview of how the world's economic system got where it is today. This is the first article we have seen that openly acknowledges that global elites and their banks destroy their own systems by cheating on one another. It explains how blockchain technology is at least a partial answer to this long pervasive problem. The following are a few key points. Dr. D is back explaining why neither gold nor the yuan nor cryptocurrencies can or will replace the dollar as the reserve currency, but together they just might. Quote, "What can't go on doesn't," end quote, is the famous quote of economist Herbert Stein. Since a spiraling deficit of $1 trillion deficit on a $20 trillion debt can't go on, what will we replace it with when it very soon doesn't? Historically, gold. But in these complicated digital times, perhaps that's too simplistic. Before World War I, the world was on the gold standard. The main part is that the gold didn't move. It stayed in the same vaults, and its ownership changed, just like today. It didn't matter how much gold existed. It simply changed price, just like today. All this changed after World War I. The nations had so impoverished themselves that they could no longer repay their real debts and restore their currencies, following a 1,000-year tradition of inflating during wars and deflating after. The deflation was too high for Britain and France, even while removing the total wealth of Germany, and they began to cheat, double counting the gold on their books to relieve the pressure. And so the non-gold system began. The inflation was shown to be a fraud supported by the highest powers in government and finance, and the real economy withdrew their lack of trust until the matter was fixed. It wasn't. As the system was fundamentally unchanged and no trust was restored, the rich were protected and law and property rights were trampled in a decade of Tom Joads. The economy never recovered. The unemployment that never existed before World War I was never cured and has continued, ever worsening to this day. But note, before, during, and after the Depression, there was the same amount of gold. The gold did nothing. It was meaningless. Only the paper promises over it expanded and contracted. With the systemic dishonesty still in place, preventing the books from matching the real wealth and production, the economy soon returned to a diseased state. While gold was illegal for men to own, the rich do so as they please and as tradition removed the gold of the United States to hold them to truth and honesty from printing too much fake money for guns and butter. They withstood the 12-year bank run until, in 1971, they folded, having lost 2/3 of the national savings gold. The world was now in uncharted territory, much more than they never returned to honesty and a gold standard after World War I. They never attempted it after World War II, going to the Bretton Woods standard. The world would use the U.S. dollar as the standard, and the U.S. dollar would be backed with their 20,000 tons of gold. Now, there was no gold standard, only unbacked U.S. dollar paper, a debt you could neither call on nor prove. As Nixon's Treasury Secretary Connally said, quote, "The dollar may be our currency, but it's your problem," end quote. Inflation started immediately. Henry Kissinger had the plan. As no one on earth was on the gold standard, not really, the U.S. dollar had only two legs, its worldwide use and military force. He made use of them both by demanding the Saudis accept only U.S. dollars for oil transactions. Although U.S. production was diminishing, the U.S. and Saudi Arabia were still the two largest oil producers at that time. Most other nations imported oil, especially Europe. Kissinger just discovered social media, the truth that virtual things have value simply because other people use them. This was, for all practical purposes, the first virtual currency, existing only in room-sized mainframes in central banks worldwide. On the side, back in the corners, the US dollar was still convertible to gold for the, quote, right kind of people, end quote, using delivery in New York and London to banks in Switzerland. The volumes of US dollar grew to trillions, while the gold component withered to billions. Yet, still the Saudis banked billions in gold before it was recently stolen from their Swiss accounts, lawsuits pending. Why? Because there is still no trust between nations and billionaires, who have a long history of cheating each other. The gold-in-hand safety valve existed to retain some trust, however distant, in the now digital system. Quote, gold is a currency. It is still, by all evidence, a premier currency, where no fiat currency, including the dollar, can match it, end quote. Alan Greenspan, 2014 interview of the Council on Foreign Relations. Apart from the Iraq War, the price of oil has been stable for 50 years. In 1950, 2 silver dimes would buy a gallon of gas. In 2018, 2 silver dimes are worth $2.22, or the price of a gallon of gas, minus the new taxes. Meanwhile, the US dollar value has dropped steadily. Doesn't that mean that it's still gold and not the dollar that is the standard, the, quote, store of value, end quote, and the, quote, reserve currency, end quote, however unspoken? Back to the $20 trillion in debt the U.S. as reserve currency was required to issue. It's now been 40 years since 1978. What happens when the U.S. dollar disappears, as all fiat currencies do? Because it seems we would have to do something. It may be that even before 1988, people already knew this conversion, this transfer, must happen round about 2018. If the old currency burns as predicted 30 years ago, what next? Will it be replaced by a gold coin or a zero coin chained under the fleur-de-lis? It would seem the new currency must be trusted, which is the original problem, must be a replacement in trade, and must be large enough to handle what are now multi-billion trade and multi-trillion forex flows. Is the answer gold? Well, yes and no. While the gold base remained stable, the overall financial system has expanded. A 20,000-fold rise, and this is only marking credit, not equities or cash. We are indeed in an inflationary period, inflation in assets owned by the 1%. A 9-fold increase in ability versus 20,000-fold increase in promises. Sounds like someone won't get paid. And you know what bankers and economists call that? Default. Massive system-ending default, the size of World War I or the Great Depression. That's how fiat standards end. It's perfectly simple. Gold rises 20,000 times or however much it must to reback the system. It always has before, even in 1979 when the price rocketed from $35 to $880, where U.S. debt to gold holdings ratio stabilized at a very reasonable 10-to-1, the classic level of fractional reserve trust. If China officially owns 5,000 tons and Russia 2,000, with the West also 15,000 collectively, we have 22,000 tons over what Business Insider says is $160 trillion in assets, and you get $7.2 billion a ton, or $226,000 per ounce. That's a 188-time increase. So gold will rise, and we'll have a $200,000 gold standard. That's what will happen? Not so fast. We could have a gold standard, and China, Russia, and other major nations appear ready to do so if necessary. But remember, we didn't return to the gold standard last time either. Instead, we cheated and moved to a digital standard stored in ancient mainframes. Why wouldn't we just cheat again? The two problems in the original chart are trust and price. We can't go to a new system if it's the same as the old. That's why the system failed and cycles from gold to silver, silver to paper, paper to gold. We can't go from paper to paper. That won't work. But we also can't so easily go to gold, asking an 800-fold increase since 2000. It would have the same disruptions Weimar had that brought Hitler, or the Jacobins had that brought Napoleon, or that Venezuela has today. And why should we? There's no need. Certainly today, you can take gold delivery in Shanghai, but as London, New York, and the Saudis discovered, the first thing that happens once you build a system of trust is to close the doors and cheat on it. How do we know the gold is there? Even though Shanghai is a third party allowing delivery, who's to say they will be tomorrow? The banks are notorious for hypothecating, doubling, tripling the gold on their books with accounting fraud backed by the full faith and credibility of governments, and no one's in the mood for trusting the Chinese any more than Wells Fargo or Deutsche Bank. That would drop us back to a hard gold standard, a $220,000 price, a halt to world trade, and possible world war we were trying to avoid. We need an accounting method that is better trusted and can't be gamed. How to fix it? An original audit adjusted for receipts and deliveries is all we need, which is where we add the blockchain. With it, Shanghai cannot double the gold on their books like Europe did in 1922, or the CME does today, marking it both received and loaned, because the blockchain only allows one position, one state at a time. Can it be cheated? All systems can be cheated. That's the nature of men. But it makes it much harder, hard enough to establish adequate trust in banks and governments that otherwise would go to war. Will it be tied to Bitcoin? Yes, but no differently than it will be tradable to the Thai baht or the ruble. With near zero cost conversions, all currencies, crypto or otherwise, will be far more interchangeable and thus to some extent identical. They may even disappear, as happened when Jackson closed the second central bank 182 years ago, and the nation essentially moved to private currencies. What will happen to the dollar? It will still exist, but in some new revised form. If it's not a store of value and it's already not the reserve currency, we just showed it's a diluted proxy for gold and oil. Why should the reformed US dollar be any different? The dollar will be our national currency, still diluted and still referring to the real currency, gold, the attached trade note, and its crypto accounting, until the next fraud and next crisis, perhaps in 2058. And that's the long story of how we leave the present debt-backed U.S. paper dollar and move to a yuan-sponsored gold trade note that is a gold-backed cryptocurrency. In some ways, we already have. Watch and see, as they have the public opening of a structure planned and established years ago. Thank you for watching this week's Santu Pirls Stock Market Commentary video featuring the proprietary Bull Bear Point and Figure Market Breadth Summary Chart compiled by Donald Pearl, www.s2pmarketsignal.com. For Santu Pirls Stock Market Commentary, I'm Cynthia Pearl, hoping that you are enjoying a peaceful and pleasant weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.